Past performance is no guarantee for future results. Any views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared during the event cannot be guaranteed. Content is offered for information purposes only. All event participants must comply with Seeking Alpha's events policy. Analysts, investing group leaders, and other third parties participating in the event include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank.
Hi, and welcome back, everybody. Thank you so much to Daniel, Scott, and Samuel for such an excellent session. We've had so many great experts today. I've learned a ton from both the panelists and the audience Q&A, to be honest. I'm Emma Johnston. For those who don't know me, I'm a quant strategist here at Seeking Alpha. I have a background in quantitative systematic equity strategies, and if you're an AlphaPick subscriber, you've probably seen me on the webinars from time to time. I really couldn't be more excited for our grand finale presentation today with Steve Cress presenting our top quant dividend stocks. Steve is our VP or our MVP of quantitative strategies. He's going to be doing a few things today. He'll walk us through a market backdrop, talk about why it's a ripe time for dividend investing, and introduce his latest quant stock recommendations. He's also going to be showing us how to leverage Seeking Alpha premium tools to select top quant stocks, so that should be really useful for you folks. We're also going to have an opportunity to welcome audience Q&A at the end of the presentation, so please drop your questions in the Q&A and we'll try to get to as many as we can. But first, I'm going to get this disclaimer out of the way. Please have some patience as it's a bit of a mouthful. Past performance is no guarantee of future results. Any views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of the content shared during this event cannot be guaranteed. Content is offered for information purposes only. All event participants must comply with Seeking Alpha's events policy. Analysts, investing group leaders, and other third parties participating in this event include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Seeking Alpha does not take into account any of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Okay, great. Now, without further ado, I would like to introduce Steve. Steve, thank you so much for being here. I let the audience know a little bit about myself, so it'd be great if you could introduce yourself and give a little bit of your background.
Sure. Emma, thank you first for that warm welcome. That was very kind of you. By way of background, I have been in the investment world for over 35 years. I'm the head of quantitative strategy at Seeking Alpha. The largest tenure in my background was spent at Morgan Stanley, where I worked for about 13 years, and I ran a proprietary trading desk in quantitative strategies. I also founded a hedge fund based in quantitative strategies, as well as a fintech company that was purchased by Seeking Alpha, which has brought me here today. And it is a pleasure to be here today in a very appropriate environment to be having a conversation on dividends. You would have thought we knew what was coming months ahead. But just by good fortune, we've got this webinar today with some great investors providing some terrific ideas on dividend stocks. And of course, you're aware of the volatility in the environment, and no better time of a period to be rotating assets into some dividend stocks to help give yourself some downside risk. Today, my presentation will go over why quant, what is driving market uncertainty in 2025, why dividend investing matters in 2025, and SA quant dividend grades, how they work. And I think the quant dividend grades and going over the dividend safety grade and dividend growth grade, which is proprietary to Seeking Alpha, will give individuals a lot of reassurance in this environment about the dividend stocks that they own. First off, I want to talk about how we achieve our results. So with quant, it's really a data-driven process, more so than talking to company management or talking to industry experts. We really let the data do the talking for us. Quantitative investing uses data, math, and algorithms to identify investment opportunities. We look for stocks with strong investment fundamentals. Particularly at Seeking Alpha, our strategy is very close to a GARP strategy, which is growth at a reasonable price. So we use diversified styles. The 5 core styles that we look for, the investment metrics that we try to identify, are companies that are collectively strong on the basis of value, growth, profitability, EPS revisions, and momentum. When we take those core investment factors, and they may not seem very proprietary to you when we talk about those investment factors, but what we do from a quantitative perspective is we take those factors that are used by most analysts that you would have at Goldman Sachs or Morgan Stanley, and we take it and we load it up into a powerful computer processing model. So when we do that, it gives us the ability to assess all companies and refresh data on them every day. And we identify companies, as I mentioned, that are collectively strong using those metrics. So that gives us the ability to filter the strong companies from the weak companies when we use those metrics. So we have a pretty good track record doing it as well. We have a back test I'm going to show you right now. And the point of showing you this test is not to say we have an investment vehicle, because we don't really have an investment vehicle that goes into CK Alpha's quant strong buys. I want to demonstrate that this really is giving you an example of the GARP strategy that we use and how effective it is. So with this back test going back to 2010, we have taken every single strong buy stock recommendation we have since 2010, and we load it up to a portfolio on a daily basis. If a stock were to fall out of that strong buy rating, it would come out of the portfolio. So we rebalance this every single day. And as you can see, since 2010, we have a very impressive track record. If you were to put $10,000 in our strong buys, it would be worth $298,000 today. Comparably, if you put that $10,000 into the S&P 500, it would be worth $58,000. Now, one thing I want to highlight here is part of this is a back test. Really, 2010 to 2019 is the back test portion. But after 2019, it was really simulated trades when we were up and running on the Seeking Alpha platform. So that actually reflects every strong buy that we've had every day since 2019. And as you can see, the performance has done even far superior during the simulated trades than it did during the back test. So I really like to highlight that. And again, it's not necessarily that we're saying buy an investment product, because we're not. We're saying this strategy, which is basically GARP with positive EPS revisions and momentum, works extraordinarily well. So what is driving the market uncertainty that we have now? Well, I'm sure when I was talking about this in late December and early January, people were not quite sure that the market was going to have a volatile period. But as we got later into the month of January into February, that uncertainty has certainly come forward. So President Trump's return to the White House has created a lot of political uncertainty. And not saying what he's doing is good for the economy or bad for the economy. It reflects change. And it's that change that led me to believe that there would be a lot of uncertainty over the course of 2025. And most of that change is embedded in the tariffs. So with the shifting policy decisions with the tariffs, that leads to uncertainty, which leads to market fluctuations. With tariffs, it's no surprise, historically, we could go back over 100 years and look at different periods where the globe had tariff wars. And we know that historically, that has been very inflationary, and typically it leads to interest rate hikes early on during the period of tariffs. And that's when the tariffs initially would take hold, prices do go up. Provided that you don't go into recession later, when eventually, if that did happen, we would find that rates would probably come down as inflation comes down. But we're not looking for a recession right now. We're not in a recession, and no one is calling for a recession. All we're saying is that there's a lot of uncertainty in early 2025. And that's why it's probably a pretty good approach to look at your portfolio and say, I might want to have some dividend stocks in there. Reason being is, we have these tariff increases, and there are other changes happening in the regulatory environment, the monetary environment, the fiscal environment. Earnings could deteriorate on a number of companies. And certainly, even without those changes on the Mag 7, the forward earnings growth rate is lower for almost all the companies compared to the year-over-year growth rates. And that's without any policy changes. So it's something to certainly be aware of in terms of what's creating the uncertainty in 2025. So taking a look at presidential directives impacting market uncertainty, you can see on the chart on the left-hand side, the price of gold. Now, this is something that we don't see often, but gold has gained for 8 weeks in a row. And the last time we saw that was in 2020. So this is a clear indication that we're in a risk-off environment as capital and equities are being sold off and rotated into either cash or gold or sectors that historically are defensive. You might recall the saying, what's good for GM is good for America. So you probably saw the CEO on one of the news networks not too long ago for GM and for Ford, the CEO for Ford saying this is chaos, and the CEO for GM saying that this is definitely going to lead to some price increases. Of course, some of the news that we're seeing today is that some of those tariffs could be put off for another month that impact the auto sector. So again, just a real period of uncertainty. The initial tariffs were imposed on February 4th, but later suspended, adding to the uncertainty. There were market losses on the back of that, particularly for the automakers. Today, you're seeing some of those automakers rebound at the prospect that maybe some of those tariffs might be moved off a month for them or longer. Again, just a lot of uncertainty. Markets hate uncertainty. The 25% tariffs on imports from Canada and Mexico, except for the Canadian energy, which is about 10%, were reinstated on March 4th. Financials, automakers, and big box retailers were the hardest hit stocks during that period. We certainly felt it early on with the financials and certainly the automakers as well. Potential tariffs, targets on cars, chips, pharma, and those imports are expected to start as soon as April 2nd. Announcements have contributed to cautious investor sentiment, with, as I mentioned before, gold seeing the longest consecutive gains since the pandemic. Earnings deterioration. Okay, this is something we were expecting without the tariffs, but when you add tariffs on top of it, certainly there will be earnings deterioration across a much broader number of companies. So early on, probably in the third and fourth quarter, I had been discussing the Magnificent Seven and the amount of capital and the concentration risk in the S&P 500 with those stocks, and it became evident as we look at the chart on the right-hand side that you could see that it's a very challenging road ahead for the Mag 7 as their forward growth rates are lower than their year-over-year growth rates, as you can see for just about every company there except Tesla. So 6 of the 7 stocks, experiencing lower growth for their forward growth rates compared to the year-over-year. If you look at the far right side of that chart, it actually shows you the growth rate. So the average year-over-year growth rate for the Mag 7 was 77%, and the average growth rate going forward is 38%. That is a huge drop. So that is earnings deterioration from the 7 largest companies in the S&P 500. So certainly that creates uncertainty for the market. The Magnificent Seven, their earnings could continue to deteriorate not only into the next year, but the following year as well. So it really provides quite an unstable environment for the large cap companies. As you can see by this table here, investors typically favor defensive sectors in times of market uncertainty. So if you look to the far right, the 1-month number, that is the return for the last 4 weeks for the sectors. You can see consumer staples is up 4.3%. Real estate is up 4%. Healthcare up, I should say it's under just 1%. And utilities up under 1% as well. Those are typically the 4 sectors that perform favorably when the market gets defensive. All the other sectors you can see over the last 4 weeks are underwater, and this is something that you could probably expect to continue during periods of uncertainty. Now, of course, we don't know how long the periods of uncertainty will last, but we do know we're firmly in that position right now. So a lot of assets have been rotating into these sectors. And another area where investors tend to rotate is into dividend stocks. So dividend stocks help prevent some of the downside and offer a little protection. So brings me right to this slide, why dividend investing matters in 2025. Multiple factors, as I mentioned, are contributing to the market uncertainty, and dividends could provide a steady income stream, which is advantageous for retirees and those seeking passive income. But you don't only have to be a retiree. If you're just looking to protect your assets, you probably want to get rid of a lot of the speculative holdings, perhaps companies that have negative earnings, companies where you're forecasting a couple of years out, they'll be making profits. Those companies will be hit the hardest. And also other companies that tend to be hit pretty hard are companies with strong fundamentals. Now, I do advocate that you hold on to your stocks with strong fundamentals just to expect volatility. But for holdings that are the more speculative nature, those are the ones that I would say you're probably best selling out of in this type of market and purchasing dividend-oriented stocks. So you really want to use a barbell approach where you have stocks that have strong fundamentals and stocks that have dividends. I'll get to why you want to hold on to those stocks with strong fundamentals even though in the near term their prices could deteriorate. But bottom line is dividends can serve as an effective hedge against inflation, which remains a threat in 2025. Now, how do we pick our quant dividend stocks? So we have a proprietary system at Seeking Alpha, which helps provide protection for individuals that have dividend stocks or portfolio dividend stocks. In fact, I'll show a little bit later in the portfolio tool how you could take a look at your dividend grades. And we have created this because many of our investors and subscribers at Seeking Alpha own dividend stocks. There are very few platforms that tell you about the safety of that dividend or the potential growth of that dividend relative to other companies. So what we did is we created an algorithm for dividend safety, dividend growth, dividend yield, and dividend consistency. So we can measure a company relative to other stocks in the sector and get an instant characterization how that dividend looks in terms of those four characteristics. So dividend safety is the company's ability to continue paying current dividend amounts. Again, this is sector relative. So when we look at the metrics, and again, these are the underlying metrics for each of these overall factors, we're looking at those metrics compared to the sector. So again, that approach helps us determine the strong from the weak. For dividend growth, we're looking at it from the attractiveness of the dividend growth rate when compared to peers. For dividend yield, we're looking at the attractiveness of the dividend yield compared to peers. And for dividend consistency, we're looking at the company's track record for paying consistent dividends. Many of you might be familiar with the concept of dividend champions or dividend aristocrats. That would be similar to our dividend consistency grade. So the importance of dividend safety. So we have backtested these, and I want to highlight a summary on the dividend safety grade. We were able to show going back to 2010, Seeking Alpha's dividend safety factors have demonstrated accuracy at avoiding or predicting dividend cuts. 98.77% of dividend cuts were averted if you own stocks with a dividend safety grade of A+ to A-. In a similar fashion, at the same level, 98% of dividend cuts were averted by owning stocks with a dividend safety grade of A+ to B-. So that means if you have a company and the dividend safety grade is above B-, you pretty much can rest assured that in 98% of the occasions historically, those companies avoided dividend cuts. Conversely, 93% of all stocks that cut their dividends had a dividend safety grade of C+ or lower, being in the range of C+ to F. And 70% of all stocks that had a dividend safety cut had a dividend grade of F. I like this point over here too, because people often want to take a look at what happened after the pandemic. 41% of all stocks that had a dividend safety grade of F at the start of January 2023 cut their dividend within the next 12 calendar months. So as you can see, we've done a pretty good job with our dividend grades, and we've backtested them to 2010. Also highlight that if you are interested in dividend growth, if you invested in stocks that had a Seeking Alpha Quant strong buy and a dividend growth grade of A+, you outperformed what we consider the best benchmark for income and appreciation, which is the Vanguard ETF, ticker symbol VIG. And you can see by owning that basket of stocks, the quant strong buys with a dividend growth rate of A+, it was up 722% versus the VIG up 475% for that period from January 2010 to date. So we really believe our dividend growth grade is very effective and our dividend safety grade is very effective.
Steve, can I just jump in here real quick, because I work with you on a day-to-day basis, and I know that dividend safety grades and dividend growth grades are paramount for you. But what about yield and consistency? Why do you prioritize dividend safety and growth over the other two?
Yeah, the dividend consistency, there's a lot of people that look to the dividend aristocrats and dividend champions. But I have to tell you, from my standpoint, when I look at stocks, whether it's for capital appreciation or on a dividend basis, I look at the recent history, but I look at the future as well. So with all our stocks, our model incorporates historical data and forward data. With the dividend champions and the dividend aristocrats, those models are usually backward looking. So I love the fact that a company could demonstrate that they could pay for 25 or 30 or 50 years, but you really don't. You've got to have a good idea of what that company is going to be doing going forward, and is this business going to be sustainable? And as everyone knows, there are many stocks that were at the top of the index 50 years ago that are no longer there today. So the environment changes, companies' balance sheets change, their income statements change, their cash flow changes. And that's why I don't like just looking at dividend consistency. With dividend yield, too many investors fall into this trap where they try to chase high yield. Typically, the higher the yield, the riskier the situation. Often as that yield goes higher, it means that the stock price is declining. So for me, when I want to take a look at a company that has a dividend, the most important factors to me are dividend safety and dividend growth. So that was a great question. Thank you, Emma.
Super helpful. Thank you.
So top quant stocks for income generation outperform the market. So this is for a very brief period. I started sort of with this drumbeat that there was going to be market uncertainty going into 2025. And in the beginning of the year, in January 21st, I issued top dividend stocks for 2025. And you could see by looking here that most of these stocks, well, I'd say, half of the stocks performed okay. The other half did not perform okay, which is actually the norm with investing. Your very best hedge funds in the world typically have a win rate of 48 or 49%. The key is to having a portfolio of stocks. And when you have that portfolio of stocks, your top few performers make up for all the other stocks. And that's certainly the case that happened here. So the average return on the 10 stocks that I recommended back on January 21st was a return of 1% versus the S&P 500 for the same period, which was down 4.34%. The forward yield, as you can see on the right side, is substantially higher than the S&P. So the average forward yield for those stocks was 4.34% versus the SPY with a yield of 1.28%. So if you take the total return for the stock's performance and for the average yield, that's actually a pretty sweet return in such a brief period. Now, again, not all the stocks traded up, but that's why you own a portfolio of stocks. And that's why you don't want to put all your eggs in one basket, whether you're looking for capital appreciation or income generation. It's really important to have a diverse portfolio because, normally half your stocks will do well, the other half won't, but it's your top performers that will help make up for that. So without further ado, we're going to go into our top recommendations right now for March. We have 10 stocks that we're going to go over. First, I'm going to start with a Clorox company, ticker symbol CLX. It's a huge company. It's got a market cap of about 18 billion. It is a quant strong buy. And this is in the consumer staples sector. It ranks number 4 out of 183. And within household products, it ranks number 1 out of 13 stocks. As I mentioned earlier, consumer staples is a sector that investors tend to rotate to during periods of uncertainty, or if you expect we're going into a bear market or recession, consumer staples is a good sector to be in. And this is one of our top choices. Clorox has a yield of 3.24%, so that's significantly above the S&P 500. And they're doing quite well. They had a double earnings beat for fiscal year in the second quarter for 2025. They have a strong international presence, leading to market share gains in many categories. And again, when it comes to tariffs, I just want to highlight, we do look at forward estimates. We take the consensus estimates from analysts. So that gets baked into our growth factor. So as analysts change those numbers, it would happen almost just like really with a one-day lag for any company. We incorporate that consensus growth rate from the analysts, whether it's revenue growth, earnings growth, EBITDA growth, it goes into our model. So as those analysts make changes, we make changes to the model as well. So this company has been doing a great job. And what I'm actually going to do is I'm going to take us to our platform right now. So we're going to go to the Seeking Alpha platform, and you can actually see what Clorox looks like on the platform. So this is Clorox. As you can see, the stock is up just slightly today. It's been a very volatile day for the markets, being down in the first half and then trading up in the second half on the prospect that there might be a lightening up to the tariff jawboning, which has been occurring on a day-to-day basis. But you can see, if you look on the right side, there's a forward dividend yield on stock of 3.24%. You can see the Seeking Alpha analysts, the contributors have a hold consensus on it. Wall Street's consensus is a hold. However, Quant is a strong buy. And as we look down and we're looking at the factor grades, we can see the valuation is a bit expensive for Clorox. And I'll click into that. And it's no surprise that with the consumer staple stocks, which many investors have been seeking out, the valuations have been getting more expensive on those stocks. And we're going to see some of the underlying metrics pop up here briefly, which I think I have a slowdown in my internet connection today because it is pouring where I'm at. So you can see here some of these metrics have popped up. The PE for the trailing 12 months is a C minus versus a group at 21 times versus a sector at 16 times. So you can see it's about a 30% premium to the sector, hence the C minus grades. And if you look at it on a forward basis, it's about 20 times versus the sector at about 16.2 times. So a little bit of a premium there. However, one thing I will highlight where you see that A plus, it's on the peg. And for those who are familiar with my webinars, this is a particular metric that I really like a lot because it takes the conventional PE, but it combines it with the company's earnings growth rate as well. So it creates a very unique metric when you combine PE and growth. So it sort of gives you the perspective of growth and value at the same time. And you can see on this basis, it's actually very, very inexpensive. So the metric comes in at 0.09 versus the sector at 0.79. So on this valuation metrics, it's actually almost a 90% discount to the sector. So I look at that very attractively. When we look at all the underlying metrics here and we look at the total valuation grade, it's important to know that the weight that we have in our model is not equal weighted for the underlying metrics. Some metrics are more predictive than others. Hence, there's a heavier weight placed on certain metrics. I'm going to take us to the growth icon right now. So we're going to allow for that change. And that was a little bit quicker. You can see the overall growth grade for Clorox is A. And this is great to find a consumer staples company with this kind of growth. So the revenue growth rate for year over year and forward, it's a little bit lower than the rest of the sector. But you can see on an earnings basis, they are really maximizing their efficiency. And you can see they have had tremendous earnings. The year over year EPS growth rate was 478%. And on a forward basis, the EPS growth rate is 12.9%, more than double the sector at 6.4%. So you can see the EPS forward growth rate is at a 101% premium to the sector. And that is very strong, something rarely seen with a consumer staple stock. So a lot of the bottom line numbers really look terrific. If we click on profitability, you can see it's an A plus grade for Clorox. And, you know, in a volatile environment where there's a lot of uncertainty, really want to find companies that are quality companies that have a lot of profitability. And that's exactly what we're seeing here from Clorox. You can see the gross profit margins are ahead of the sector with a B grade. And if you look on return on common equity for the trailing 12 months, it's a crazy level. It's so high. Look at return on capital, still an A plus, return on total assets, an A plus. So you can see some great numbers overall for the profitability and for the cash per share, which I often think is important during volatile times. You want to know that your company has cash to pay its dividend. It's a B minus grade. It comes in at around $2.35 versus the rest of the sector at $1.87. So this is what we look for in terms of underlying metrics for the companies that we are selecting. The next on the list is Pfizer. So I'm going to take us over to Pfizer. So you can see Pfizer has been pretty flat for the last year. And on a year-to-date basis, it's down about 2.45%. So it's outperformed the S&P 500 is down a little bit more, I believe, for the same period. But you can see Pfizer has an excellent valuation. Really what's excellent about Pfizer is the yield. The forward yield is 6.68% on Pfizer, and the valuation is A+. It's within the healthcare sector. So it's not the highest ranking. And again, we're not really looking for the highest ranking company or the top ranked in the industry. We want a company here that's been fairly stable. This is the only recommendation that we're bringing forward today that has a hold on it. In previous days, it was actually a buy, and it just fell to hold. But I feel very comfortable because with that 6.68% yield, that should help prevent some downside risk to the stock. The growth has fallen off for the company, but what is also important is the profitability in an uncertain environment. So if we take a look at the profitability card, you can see that the gross profit margin is 74% versus the sector at 59%, hence the B plus grade. But if we take a look at the EBITDA margin, that has an A plus grade with a whopping margin of 36% versus the sector at 6%. So it's at a huge premium to the sector. If you look at leverage free cash flow margin, that's at a big premium to the sector. Healthcare for return on equity, the sector median is actually in the negative domain. It's negative 39%, so it's an awful sector when you look at it across the board for the median of ROE. Happy to say that with Pfizer, it's got a positive ROE at 9%, so much better than the rest of the sector, hence the A grade there. And when you look at cash from operations, it's got 12.74 billion. The cash per share is relatively low, but we feel fairly comfortable with the company because when we take a look at the dividend safety grade, you can see that there are a number of Ds there for the conventional metrics. So as I had said earlier, our metrics are not equal weighted. We know from backtest which ones are more predictive. So as you take a look here, you can feel some confidence from our history and our backtest that even though you're seeing some grades that are in the red, which could be, a lot of people will look at dividend payout ratios or cash dividend payout ratios. There's more to it than just those ratios. So as I scroll down, you'll see a couple metrics like net income margin, return on common equity, cash from operations that have more powerful grades in the C. And you can look down and you'll see some, such as the percent of security owned by active institutional investors. You can see the percent of total downward DPS revisions, the funded status of their pension fund. These are really important metrics, and they tell a lot to us when we look at these metrics historically. So to many individuals, that might be surprising, but as I showed you earlier in the presentation, 98% of dividend cuts were averted if you owned a company that had a dividend safety grade of B- or higher. I'm going to take us to our next stock, which is Dominion Energy. So Dominion Energy, over the last year, it's up about 17% year to date. The stock is just above zero. So that's positive considering we're looking at an S&P that's in the negative domain. The yield is quite nice on Dominion Energy at 4.91%. We have some really good metrics overall. This is a buy rating, but the valuation is a B plus for it versus the sector. And Dominion is in the utility sector. The growth rate is A minus versus the sector, and the profitability is A versus the sector. So far we've looked at our first stock, which was the Clorox company that was consumer staples, Pfizer, healthcare, Dominion Energy, utilities. These are the sectors that people most commonly rotate to during periods of uncertainty. And as you can see, the strength is fairly high in the sector. It's 9 out of 105. And within the multi-utility industry, it ranks 5 out of 20. But I'm going to take a look at the valuation here. And this will come up within a second. You can see it's B plus overall. If you take a look at that PEG metric, which I like so much because it combines both PE and growth rate into one metric, a very powerful A plus at 1.03 versus the sector at 2.65. So it's about a 61% discount on that valuation framework compared to the sector. So again, a very powerful metric there. But even the PE on a forward basis, it's 16 times versus the sector at 18 times. And PE on a non-GAAP basis, very attractive as well. If you look at conventional metrics such as EV to EBIT, that gives you a B minus. And if we look to price to book, it is a B minus as well. Dividend yield versus the sector at A minus at 4.91% versus the sector at 3.5%. So looking very attractive on a valuation basis. If we look at growth, you can see the forward revenue growth rate is actually stronger than the utility sector at 5.2%. You typically don't see huge revenue growth numbers for utilities, but this does beat the sector. And if we take a look at EPS growth on a forward basis, this is fairly important. It gets an A grade. The forward EPS growth rate is 21% compared to the sector at 6.6%. That's a whopping 230% premium to the sector. So very strong on that basis. Same with EPS on a GAAP basis going forward, 16% versus the sector at 16.4%. Also, a really strong metric for growth is long-term growth. So here we have analysts that have a model that goes out 3 to 5 years, and we look at those analysts and they give it an A plus. They're looking for sustained long-term growth of 15% versus the sector at 6.7%. So again, not all these metrics are equal weighted. Some are more predictive than others, and that's how our model works. So when you look at that overall growth grade, you know that we're placing more weight into more powerful metrics. Emma, I'm going to take us back to our presentation.
Right.
And we're going to increase the slide. So for anybody who's looking on their phone, it'll be a little bit easier to load. So we did the reviewed the Clorox company, we reviewed Pfizer, and we reviewed Dominion Energy. So I have a couple bullet points here, that add to a stock like Dominion Energy. You can see the data center growth has been driving their significant growth rates going forward, particularly in Virginia, which is a high-tech state at this point. The company increased its 5-year capital investment by 16% to a whopping $50 billion, and management reaffirmed the long-term outlook at 5 to 7% annual growth through 2029. I'm going to take us to our number 4 stock, which is Regency Centers Corporation, ticker symbol REG. Going forward, I'm just going to look at the slide deck, but I'm glad you had the chance to see what our platform looks like and how you can get to those underlying metrics. So for Regency Center, this is a REIT. It's a large REIT at almost $14 billion. Within the real estate sector, it ranks 3 out of 173 stocks in our quant universe. And within its industry, which is retail REITs, it ranks number 1 out of 23. It's got a really nice yield at 3.69%. They recorded high occupancy metrics with 97% same property lease rates and 94.1% shop occupancy, which is really terrific for a REIT. They completed a $230 million in redevelopment and development projects for 2024, and they have a 4.42% forward FFO growth rate, which is a 67% premium to the sector. We look at different metrics, so typically you would not see FFO or AFFO in other sectors, but you do see it in REITs, and we do look at metrics that are centric to REITs when we consider it. So again, it's on a sector relative basis, and we can see a 54% FFO margin, which is a 33% premium to the sector as well. Our number 5 stock is a financial, Manulife Financial Corporation, ticker symbol MFC. Talk about big. This has got a market cap of $50 billion. It is a quant strong buy within the financial sector. It ranks number 35 out of 687 stocks. And within the insurance, the life and health insurance sector, it is 1 out of 19. It's got a great yield at 4%. They had record financial results in 2024, which were driven by strong performance in the Asia and global wealth and asset management segments. Now, a lot of these stocks have been impacted by tariffs and the speculation as well. So we believe, it's getting discounted into the stocks. If any of this tariff news were to change or come off, we would probably see even a bigger pop. But the nice thing about Manulife is that it has that 4.17% yield, which helps give some protection there. It has 14.26% forward revenue growth, which is 134% premium to the sector. In terms of cash per share, it is a tremendous $10.38, which is a 57% premium to the sector. I will take us to stock number 6, which is another property company, VICI Properties, ticker symbol VICI. It's got a market cap of about $33 billion. Again, a quant strong buy within the real estate sector, ranking 4 out of 173. And within specialized REITs, it ranks 1 out of 11. It has a forward yield of 5.38%. It's one of the largest property owners on the Vegas Strip. So if you're ever out of the Vegas Strip, some of those properties might be owned by VICI. They have strong revenue growth, a very strong revenue growth history with AFFO growth on a 5-year CAGR of 8.84% versus the sector at 2.74%. And the FFO margin is 70%, which is a tremendous 71% premium to the sector. Stock number 7, another REIT, Cress, ticker symbol CTRE. It has almost a $5 billion market cap. Within the real estate sector, it ranks 5 out of 173. And within the industry, which is healthcare REITs, it ranks number 1 out of 17. It's got a very nice yield at 4.4%. Of course, as is you can see, it is in the healthcare REIT segment and specializes in senior housing. They have a $325 million investment pipeline with 26.8 million closed in early 2025. The forward AFFO growth rate is 9.75%, which is a 287% premium to the sector, and the FFO margin is 96%, tremendous 139% premium to the sector. So you can see if you look on the right-hand side too, we're showing the factor grade. So from a valuation basis, compared to the sector, it has a B grade. And you can actually see, I want to highlight, and I didn't do this when I was on the platform. If you look at the far right, where you look at the factor grades, you not only can see where the company's current valuation grade is, you can look and see where it was 3 months ago and where it was 6 months ago. So the valuation framework is actually better now on the company that it was 6 months ago, and the growth has actually improved. The growth rate is an A, where 6 months ago it was an A minus. So we saw a slight improvement in growth and a better valuation. Profitability has also improved. It's an A plus for profitability now versus 6 months ago where it was an A. Yet the momentum on the stock has not been great compared to 6 months ago. Hence, that's probably why the valuation is more attractive. Yet we see very good positive analyst revisions upward. So that revisions grade gives us an indication of how many analysts are taking their earnings estimates up versus down versus the sector. And you can see the dividend safety grade coming in at A plus and the dividend growth grade at A.
Steve, you took the words right out of my mouth. I was noticing the improvement across the dividend grades for that stock as well, which is always something we like to see. And I enjoy, just looking at that incremental improvement across all those dividend grades.
Yeah, you're right. I was pointing it out with the factor grades, but even more so with the dividend safety grade, which is A plus now versus 6 months ago, it was a B. So really, significant improvement in the dividend safety grade, as well as dividend growth, which was B minus. So really, a far better improvement in those dividend grades than we even saw in the factor grade. So thank you for highlighting that. Stock number 8 is in the financial sector. It's PNC Financial. Many of you might even do your banking there. Ticker symbol is PNC. Tremendous market cap at 71 billion. This is also a quant strong buy. Within the financial sector, it ranks 74 out of 687. And within the industry of diversified banks, it ranks 11 out of 66. Has a very nice yield at 3.55%. They've been expanding at a good rate, as you can see. The footprint has been doubling for their new branch builds in high growth regions such as Florida, Texas, and Arizona. They generated record revenue in the fourth quarter, and their forward diluted EPS growth rate is 11%. That's a 14% premium to the banking sector. And they have tremendous cash per share, which always is nice when you have a dividend paying stock at $14.99 versus the financial sector, which the median cash per share is $7.45. Again, if you look at the dividend grades here, you can see dividend safety coming in at A, dividend growth at B plus. Those are ones that I really like. And if we look at the factor grades, you can see the valuation is in line with the sector as well as the growth. But what really stands out is that yield of 3.55%, which could help provide you with, a steady stock during some uncertain times. Stock number 9 is the RTX Corporation. This has a very, very, very large market cap at 178 billion. Within the industrial sector, it ranks 30 out of 612. And within its industry, which is aerospace and defense, it ranks 3 out of 57. So we all know that President Trump wants to build up our military. So probably being in the aerospace and defensive sector could be a better place to be than many other sectors. The yield on this one is not tremendous, but it still has a good dividend yield. It's above the S&P 500 at 1.88%. They specialize in aerospace propulsion systems with expertise in missile defense systems. And we've been going through quite a few missiles over the last couple of years. So I'm sure their pipeline will probably continue to remain strong. Their defense sales grew by 9% organically in 2024. And their EPS diluted growth rate, the forward growth rate, was 18% versus the sector. In terms of cash from operations, they have 7.16 billion compared to the sector at 379 million. So RTX, an aerospace defense company with a solid yield at 1.8%. If we take a look at the far right side, we could see the factor grades. This is very profitable with an A plus grade for profitability. And we could see that the analysts remain positive on this company with the EPS revisions grade at B plus versus the sector, and their dividend safety grade B with dividend growth at B plus. So looking very favorable. And finally, stock number 10, last but not least, Philip Morris International, ticker symbol PM. This is a stock that many people have gone to over the years during periods of uncertainty. They have a huge market cap at $239 billion. It is a quant strong buy. Within the consumer staples sector, it ranks 10 out of 183. And within the industry of tobacco, it ranks 1 out of 8. Has a really nice yield at 3.4%. They've been doing great in the electronic smoke space. They made $15 billion in Q4 in smoke-free net revenue from the US alone. Their EBITDA margin is at 40%, which is a 218% premium to the sector. Their forward EBITDA growth rate is at 9.74%, which is a 97% premium to the sector. And their interest coverage ratio is at 7.5 times, which is a 20% premium to the sector. And if you're going to look at something as a dividend aristocrat or a champion, the 4-year average dividend yield on this stock is 5%. So it's continually maintains a really nice, healthy dividend payout. And as you can see, if you look at the factor grades, the valuation is a little bit expensive, but again, that would be expected when you have a rotation into the main sectors that are, basically where capital flies in defensive periods. The growth rate is in line with the sector, but the company is extremely profitable. Again, I like profitable companies during uncertain periods. It has an A+ grade in profitability, and the momentum of the stock has been very strong as well at A+. And Emma, that is our top 10 stocks, and this sort of provides an overview. You can see we have Regency Centers, Clorox Company, VICI Properties, Manulife, Carrot Trust REIT, PNC Financial, RTX Corporation, Philip Morris, Dominion Energy, and Pfizer. Pfizer, again, being the only hold, Dominion buy. The rest of the stocks are strong buys, but as you look at those dividend, as you look at the grades, you can see a lot of green there, especially in profitability. We want companies that are profitable during uncertain periods. More importantly, you're looking, to have stocks that have a dividend yield higher than the S&P. And you can see the average dividend yield here is 4.15% versus the S&P 500 with a dividend yield of 1.28%. So again, looking for companies that have a higher yield than the S&P will help give you some downside protection versus the S&P. And
Sorry, Steve, didn't mean to interrupt. No, I was just hoping to cut away to Q&A while we still have time.
Sure.
I know so many audience members have jumped in with excellent questions, but that was a great presentation, heaps of information. But let's start with our first question here. So what metrics should investors use to evaluate if dividend stocks are fairly priced when considering both their dividend yield and growth potential? Specifically, does Seeking Alpha provide a PEGY or PEGY ratio in their analytics? If not, which Seeking Alpha metrics or grades would be most helpful for assessing dividend stock valuations?
Okay, so this is something that we put a lot of time and effort and resources into at Seeking Alpha. So, looking at the conventional metrics for a company where you typically would be looking for capital appreciation, and you look at the valuation metrics, PE, price to book, dividend yield, or even the PEG ratio with a yield on it, those metrics alone don't really tell the story. So I'm actually going to go back to our platform, and I'm going to highlight Dominion Energy. So we're on the platform, we're looking at Dominion Energy, and I'm going to scroll down because this really is pertinent to answering the question. So when we go to dividend safety, I'm going to click on dividend safety, which has a B+ grade. So to answer that question specifically, the metrics that are important, okay, we have a number of metrics that we're looking at. Some of the conventional metrics would be dividend payout ratio, cash flow payout ratio, dividend coverage ratio. Okay, you can see they're a little bit expensive, but the overall grade is a B+. As I mentioned, we back tested these metrics to 2010. So it's almost going to the 25 years of looking at these metrics now for dividend safety. So when you scroll down, you're going to see some other metrics that have grades of C, and you're going to see other metrics which have some green, such as the net income margin, cash flow from operations, log of unadjusted stock price, percent of security owned by active institutional investors, percent of total downward DPS revisions, and the funded status of the pension. Now, we have looked at hundreds of metrics when going over the dividend safety grade, and backtested, as I mentioned, to 2010. So the metrics that you see in green here tend to be the ones that have a higher weight in our algo when we look for dividend safety. So it could be a little bit deceptive. The historical ones are good ones to look at, and that's why we include them in our model. But as I mentioned, there are some metrics, and if you want to see which ones and you're a premium member, all you have to do is click on any stock that has a dividend, and you go to that dividend safety grade, and you could look at the wide spectrum of metrics that we look at, which are important to us when looking at dividend safety. Same thing for growth. If I scroll down, I'm going to take a look at the dividend growth. And I mentioned really when it comes to dividends, dividend safety and dividend growth are very important to me. So you can see the dividend growth grade is a B. When we look at the underlying metrics of the dividend yield growth rate 1 year, or a CAGR of 1 to 3 years, or the 3-year dividend growth rate, or the 5-year dividend growth rate, you can see many of these are in red. And that's why I said before, the dividend consistency is not always that important to me. Which really stands out to me is the dividend safety and the dividend growth. You're going to see a number of metrics here that have grades that are B, A, B plus. Again, we back tested all of these to 2010. So you know which ones we feel are more important and that we have a higher weight on. So we're looking at dividend safety or dividend growth. The metrics are not the common metrics that you think of. So, if you are definitely someone who looks at dividends, I would highly recommend that you load it up to the Seeking Alpha portfolio and take a look at a lot of the underlying metrics. Hopefully that answers the question.
That's great, Steve. Yeah, it's always good to pick your brain on how you're digging through those metrics and the story they can tell, because there's quite a few stories. Okay, next question. Markets are on shaky ground right now. Why are so many positive earnings reports resulting in share price reductions?
Yeah, so it seems that a lot of investors have moved away from looking at stocks on good fundamentals. So, we manage a portfolio that I'll tell you about, Alpha Picks, which is a separate service that we run off of Seeking Alpha, where we're looking at our top quant recommendations. And we look at 2 each month, and we issue emails highlighting our top 2 favorites. And the point that I'm making is a lot of these stocks have actually been hit relatively hard when they've had stellar earnings announcements, where their revenues have beaten expectations, where their bottom line EPS have beaten expectations. But it shows that even if you come out with a good earnings result in a market that's driven by fear and sentiment, people are really using that opportunity to sell into good results, cash in, and rotate into either cash or to some of the defensive sectors such as staples, utilities, REIT, healthcare, or gold. As we mentioned earlier in the call, gold has been doing extremely well over the last 8 weeks. It's had positive momentum, and that's a sector that typically does really well when there's a lot of uncertainty. So, if you have good earnings now, that beat expectations, if you have revenues that beat expectations, the market is not focused on fundamentals. It's focused on fear and sentiment. The good news is, and I really highlight to people, when you have stocks that have good fundamentals, you really probably want to add to those positions, because the market is selling those stocks off of fear, and markets always return to fundamentals. And you can go back over the longest period. You can go back to, the Great Depression. You can go back earlier than that. You will see most of the time when markets sell off, that is induced by fear, they always snap back. And, we eventually always hit highs again. So when we go into periods of those snapbacks, it's the stocks with good fundamentals that come back the strongest and the fastest. So they're a little bit shakier during periods of fear and where the markets are being driven by sentiment. But when normalcy returns or investors start to look at companies with good fundamentals, the stocks that have great valuation frameworks, good profitability, good growth, those will tend to outperform when we have a return to that environment.
That's a super helpful reminder, Steve. Thanks so much for that. Okay, next question. Which dividend investment best suits the current market, which I see is rather overheated?
Which dividend investment?
I think we could look at this from a sector perspective, or, obviously we've talked quite a bit about dividend and growth, but maybe we could, reiterate our thoughts on sectors at the moment.
Yeah, I think that's a good grounded question, and it really just speaks to what I was mentioning. When a market is driven by fear and sentiment, People are not that interested in technology stocks or consumer discretionary stocks or industrials. They get a little nervous and they want to go where they know companies are going to have earnings no matter what. And you typically find that within consumer staples. They're still going to buy food. They're still going to buy beverages. They're still going to have to buy household products. So that's why people tend to go to consumer staples during periods of uncertainty. People still want to have lights in their house, so they're going to pay that utility bill. So the utility sector continues to do well. People are going to still pay attention to their healthcare. Okay. You're going to take some of those discretionary dollars that you had and you're going to focus on what's important. Health is always a priority. So healthcare stocks tend to outperform in indecisive times. So I think, yeah, we got utility and real estate. Many people still need a place to live. So if you rent or if you have a business, you're going to make sure that you pay your rent so you don't get evicted. So those are the sectors that tend to do well during periods of uncertainty. And again, we don't know how long the uncertainty is going to last, but we do know we're in a period of uncertainty right now. So many investors, as you can see, and we pointed out on that table over the last month, have been rotating assets into those four sectors.
Great. That's pretty intuitive, but it's always a good reminder. Thank you, Steve. And then I think probably our last question for the session. How do you think about the pros and cons of different metrics for a company's dividend, i.e. in light of its cash flows, net income, or other metrics?
Yeah, so I think, we sort of answered that when I was reviewing the dividend safety and dividend growth. There are more metrics that are more important to others. A lot of those are surprising, and that's why we backtest all those metrics. Our backtest runs almost a 25-year period, and you can see the results were pretty exceptional. So it might not be the metrics that you expect, and that's why our dividend grades are so important. And really, even when you're looking at capital appreciation, if you're looking at value, profitability, growth, you have to look at the underlying metrics and you'll see, it's not equal weighted because sometimes when you look at that overall grade, it's not that intuitive when you look at the underlying metrics. So not all metrics are created equal.
Great. Ain't that the truth, Steve? Okay, I think we can hop to the next slide in the presentation. Just
you did mention something. I guess, we're in March here, and obviously, people will be investing beyond today. I'm actually going to take us back to our platform briefly. So I just want to highlight that. As I go to our platform, after today, stocks move every single day. Some of the stocks that we have a strong buy on now, those ratings could change. So a lot of times you're going to be wondering, what is the best way to find stocks? So if you go to the Seeking Alpha platform and you're a premium member, if you are on the left-hand side and you scroll down, you can go to the stock screener, and I'm going to click on the stock screener. And I have a lot of my own screens, but we have pre-baked screens for you. So I'm going to take you right to that area, and everybody can create their own screen. So we're like over here, you'll see on the far right side, it says create new screen. You can create your own screen and save it. I have a lot of screens. So I'll have like China ADRs, I'll beat up buys, I'll have hidden gems, I'll have high yield, high risk. So I have a lot of my own little unique ones. Everybody can make these themselves. But to make it easier for our subscribers, we have some screens that are pre-baked. So after today, I recommend anytime you want to buy a stock, you always look at it that day because stocks trade every single day. And with each and every single trade, the valuation framework is going to change. The growth framework is going to change because it's all relative to how it interacts with that stock price. And it's all relative to the rest of the sector stock, the stocks in the sector. So if you want to look at dividend stocks after today, all you have to do is go to the Seeking Alpha screen. You can click on top dividend quant stocks, and it will populate for you. And you're going to see it's actually a little bit different than some of the stocks that I recommended today. The ones I picked today were sort of handpicked by myself. But you can see that Clorox is there and VICI Properties and Caratrust. But you can see a couple other companies. I was focusing on companies that had a balance of a good dividend yield and good grades. And the beauty of this is when you go to the screener, you can sort of sort. So if I want to sort by companies that have good dividend grades and high yields, I can simply click here. And you can see VICA Properties comes towards the top. CTRE comes towards the top. Then there's a financial, which is Moelis Company, Central Properties, PNC, Philip Morris, Clorox. So you can see sort of my little trick for today was I actually sorted by dividend yield. So I didn't go for necessarily the highest quant rating. I was trying to get a balance of strong buys with dividend yield and a little bit of diversification from the sector. So I had consumer staples in there, I had healthcare in there, and I had REITs in there. So I just want to highlight, if you're a premium client, you could do this on your own. You don't need me and the webinar today. You could always look at these stocks yourself. So one other thing I will highlight about the portfolio of stocks is from the stocks I selected today, you can easily create that portfolio on your own. So we have a portfolio tool. And if you look at the far left side and you scroll down, you can see I have quite a few portfolios. I'm a portfolio junkie. But if you click on portfolios, it'll give you the ability to, it'll say new portfolio. And you could just add the dividends. You could just add the ticker symbols and it'll feed right in. So this gives me a great view on the dividend grades. And I can see most of my dividend grades are in the green, which is exactly what I want. But something else like I might be curious about is I want to see what the earnings picture could be. So most of these stocks have reported recently. And if I look at the last quarter, as the results come in, I could see that most of the 10, 7 out of 10, the companies beat analyst expectations. 2 were a little bit shy of the expectations. But, VICI is a property company. It still has a really great balance sheet. It's got a great dividend yield. So I was okay putting that in. And you can see the next one down, CTRE, which is also in the REIT sector, a little bit shy in terms of what they reported, but I'll take it, only 2 cents off of 32 cents. With VICI, it was 9 cents off of 68 cents. So very acceptable. But most of the companies across the board, they beat expectations, which was really important. And then you could, take a look at a summary of the stocks where you can see the quant ratings. So a lot of different things. You could look at the growth rates for these companies. So if I click on growth, and this is really something that sticks out to me about these growth rates. If I simply go to the EPS forward growth rate, so obviously I'm more concerned about the future than year over year. I can see that most of these companies, especially for dividend paying stocks, have really healthy growth rates. So this is the EPS CAGR going forward. VICI a little bit lower, but still in the positive domain. And as you can see, going up from there, it just gets better and better, with Dominion at a 21% growth rate and CTRE at a 42% EPS growth rate. If I look at it from a value standpoint, I could take a look at the PEG ratio for all the companies, and that's my favorite. And you can see for the most part, these PE, the PEG ratios, I believe I clicked on, PEG forward. You can see it's fairly attractive if you compare it to a sector basis. So great portfolio tool, but really, you're monitoring your dividends. The first thing that you should check out every single day for your dividend stocks is looking at the dividend safety grade and dividend growth grade. And you want to make sure that it's above B-. And Emma, I think, that is really it for the presentation. I will just sort of add, if this seems like a lot of work to you and you want us to do the work for you, we have our Alpha Picks product. I launched Alpha Picks in July of 2022. Alpha Picks is the product where I take my 2 top quant ideas every month. So on the trading day closest to the 1st of the month and the 15th of the month, I send out an article, and it's either through email or you can go to the Alpha Picks platform to read the article, and it will highlight what our quant strong buys are. And as you can see, since inception, it's been performing really well, up 136% versus the S&P up 52% for the same period. So again, if you don't want to do all this homework on your own, we have Alpha Picks where we do the research for you. Emma, I think I'm pretty much on there.
Thank you so much, Steve. Love learning about how we can curate all those portfolios and the stock screeners. Those are very fun to play around with. I can't emphasize that enough. So folks who are premium subscribers, please jump in there and play around, because you can learn a lot and it's very fun. But I wanted to thank Steve for sharing his valuable insights. I know I came away from this webinar, learning a lot. I also want to extend a thank you to our brilliant experts and analysts who took part in today's program, from baby bonds to YARP. We had the full run of dividend approaches, and that was wonderful. On that note, finally, a thank you to our community for joining us and participating in this event. We hope these conversations and various angles, you're walking away with new and valuable strategies that resonate with your personal investment approach. As a reminder, all video replays will be posted on Seeking Alpha's Video Hub. That is seekingalpha.com/videos. Thank you again for being a valued member of the Seeking Alpha community, and we hope to connect with you again soon. I hope you enjoy the rest of your day. Take care.